Out of all of the stocks in my coverage universe, StoneCo is certainly the one that is the most undervalued. In fact, when I compare it to other innovative Brazilian companies like Nubank or Mercado Libre, StoneCo is trading at 2 times enterprise value over trailing 12-month gross profit and 1.5 times enterprise value over forward gross profit. These are my preferred metrics when I look at growth stocks. And when I look at my equivalent of a PSG ratio, we are at a 0.04. So well below 1, really low price for that company. And that company has fallen from grace. And that's why I believe StoneCo may be a good company to take a look at right now. So what does StoneCo do? StoneCo is kind of a mix between a 72% or 75% of a Square payments and a mix of, say, a QuickBooks or an Intuit or some sort of ERP system for small businesses. That's essentially what StoneCo is, but for Brazil. So it handles payments and financial services for small businesses. That's still the bulk of the business, and that's the original business. And they are launching and developing and growing their software solution and kind of cross-selling between the two. StoneCo got into the software business thanks to its acquisition of Lynx. It acquired Lynx for $1.28 billion in late 2020 when their stock was at the highest, and that seems to be a good move in my opinion, using your stock to acquire a leading company in Brazil. Lynx, we can see, had software that focused on a lot of medium and large corporations, and StoneCo was mostly focusing on SMBs and especially small businesses. And some of the services and payment platforms and systems and terminals that StoneCo has developed, StoneCo is now trying to introduce software solution, and Lynx is trying to use the capabilities and trying to expand these software capabilities to the financial services. So they're kind of merging both systems. They're merging the financial services, the hardware, the payment system, and bringing it to the customers of Lynx. And the product of Lynx, the software solution of Lynx, they are bringing them to the customers of StoneCo, and that's the essence of this merger that they did. And I think it's a pretty smart merger, and it's good to see that the company is becoming more balanced. And so in the future, a few years from now, this company may be 50% payments and 50% software solutions. And software solutions obviously come with higher margins, and it's an even better business. So this business has a lot going for it. But, and there is a but, this business has been essentially left for dead for more than a year now, because it fell from grace, right? It reached a price close to $100, and it's lost most of its value. So it's lost 90% of its value since February 2021, which was the peak of innovative company. And this company was deemed by the market to be one of the more innovative, promising plays. What's very interesting is that StoneCo fell from grace much earlier than any of the other high growth tech stocks. And so we could guess that it's earlier in its recovery, but you can see by the beginning of 2022, it had essentially lost all of its value, and it stayed flat throughout 2022. So I would argue this stock would have a hard time getting any lower. And if you buy the stock now, you have an opportunity to buy it essentially at all-time lows, almost at all-time lows, and you're buying it for cheaper than when Warren Buffett bought it, who bought it at the beginning, and cheaper than what Cathie would bought it most of the time she bought the stock. So this stock has been a catastrophe to own, and the market has forgotten about it. That's the best way I can think about it. But there's been a lot of good things for this stock, right? There's been recently, but nobody follows it anymore. But recently, there's been a few good things. There's a new CEO. A new CEO came in November 2022, and actually the stock went up 17% on news of the new CEO. The old CEO had been there for many years, and he became board member, moving on to something else. And what I like about the new CEO is that it comes with a stock-based compensation plan, which vests as the stock reaches multiples of the stock price of November 17, 2022, which was $9.76. So if the price double, triples, 5x, 10x, there will be compensation for the CEO. So this is an alignment plan with the CEO and and the shareholders. So I like to see the alignment there. I also like that I'm investing in this stock along with Warren Buffett and Cathie Wood. Warren Buffett owns 3.86%. He owned a little more and he sold a third of his position back in early 2021. But ever since he hasn't sold StoneCo and still owns 3.86% of StoneCo. Warren Buffett is in this stock, and Cathie Wood owns almost 1% of StoneCo, and she's still relatively actively buying it because she bought in June 2022. That was her last buy at $8.21. So even though the stock has fallen off of everyone's radar, the stock has not been sold by these famed investors, and so it's always reassuring to be investing next to astute investors, people that know what they're doing. Revenue growth. I think it's important to look at revenue growth here because we can see that as the stock was crashing throughout 2021, revenue growth wasn't doing much, right? The stock was mostly trading on a story. Most, and by the way, this is like just about each quarter. I matched the years. So the stock was pretty much a story growth stock, not growing much. And then for like probably half of 2021, they had to take a lot of write-downs, so there were a lot of losses on credit because they had an issue with their lending to small businesses where there was an issue with the collateral system, and so they've lost a bunch of money, which explains why the stock is so down. But now that the market has punished this company and has forgotten and moved on from this company, what's very interesting is that there's been a breakout in revenue throughout 2022. Growth has resumed for StoneCo, and you can clearly see in the number that the stock has been growing consistently over the past 5 quarters after this catastrophe happened in 2021, and the stock, lost essentially 80% of its value and maybe another 10% now in 2022, but it lost most of its value in 2021. So, and what's interesting is when you look at what analysts expect 55% forward revenue growth for this stock. So the stock has resumed, and I would even say has started hypergrowth. It has started entering an hypergrowth stage, but the stock price has not reacted. So I think this is a little inconsistent. What about revenue headwinds? Well, there's some competition. So one of them is called Pago Seguro or PagSeguro. This company is not very well rated by a lot of analysts. I have very little way to know how well we're doing, but I based on what I've read, I don't think we are doing as well as StoneCo. And then the legacy bank, right? It's just like the US legacy banks still sell their terminals. So you have some competition, but StoneCo is the leader. As far as concentration goes, StoneCo operates in the Brazilian market only. And so I did a video on Brazil addressing some of the issues and opportunities in Brazil. So it's up to you to decide whether you think Brazil is a risk or an opportunity. But the concentration in Brazil is there. Customer retention is amazing because it's mostly recurring revenue. And so that's why they have very high margins. Recurring revenue is better than one-time sales. Macro sensitivity, there is some sensitivity to interest rate since they deal with a lot of small businesses. However, the interest rate situation in Brazil and the inflation situation in Brazil has been very much like the US, where their central bank has had to raise interest rates. And right now, inflation is receding over there and the rates are easing over there. So we are in a very similar situation there, where yes, interest rates have hurt the business, but interest rates will be coming down probably soon. What's the growth runway like? Well, Brazil is at an early stage of digitalization, earlier than the US. So we can think, I like to think of this opportunity as Square of the early days. Think about Square in 2015. I believe that's where StoneCo is. Digitalization is more nascent over there. So there is a huge growth runway with that, and businesses are very interested in being able to receive different payment methods and different cards. And so it's, the end of cash is true in Brazil, just like it's true anywhere else. And so that's another opportunity that we're writing. These small businesses, if they want to do well, they have to accept different forms of payment, and Stone allows them to do that. Growth by acquisition. Yes, there has been one, as discussed, links, and I do not like growth by acquisition in general. This is an orange flag, and the reason why I say it's an orange flag is because they astutely used their quote-unquote overvalued stock to make an acquisition. And it's funny, Square did the same thing with Afterpay. So they saw that their stock was so valuable, and they issued shares to acquire another company thanks to their stock. So yes, I do not like acquisition, but I think in this case it's an orange flag since they paid for it with an astute method, I would argue. All right, SG&A. SG&A is important because, we want this to go down. We want net margins to go up. So we want general expenses, selling expenses. We want all of these to go down. And that's what's happening at StoneCo. So this last year, where the stock hasn't moved and nobody focuses on this company anymore, we've seen wonderful changes. Selling expenses are down 15% of revenue in Q3 of 2022 against 21%. So down by more than a fourth. And administrative expenses are even more down. They're at 11% of revenue admin expenses versus 24% a year ago. So this company is focusing on profitability. They're growing revenue, they're defending gross margin, and they're reducing operating expenses, which is what I like to see. The company is becoming profitable, and hopefully, as the company becomes profitable, the market will notice. Let me walk you through some of the numbers that I like. Are there any near-term bankruptcy risk? No, there's not. The company almost has $1 billion on cash on hand, and the market cap, get this, is $3.1 billion. So much of that market cap the company has in cash. Not net cash though, because the company has some debt at $1.1 billion. They are in financial services. It's acceptable to have some debt when you operate with financial services. But the free cash flow is very high at $655 million. And the debt to equity obviously is low, is very low. So I'm happy with 0.27. If most stocks had this low, I wouldn't be complaining. Gross profit margin is almost software-like. Oh, I say almost because pure software is more like 80%, but it's almost software-like. So 74% gross margin over the last trailing 12 months. Very high. The enterprise value over forward gross profit is 1.52. Enterprise value over free cash flow is only a 5. And this is what's even more interesting for a company this early on in its growth stage, is you can already calculate a P. So the Q3 net income was 37.5, right? And so if I do an instant annualized type of net income, I take 37.5 multiplied by 4. That's 150 million right now of earnings. So your snapshot PE would be at a price of $3.1 billion for the whole company market cap. Over 150, you're at 20.6x, which is low for a company growing at 55%. And for a company growing at 55%, you're paying 13.3x next year's earnings. So again, very low for a company that has a long growth runway, and I think they can keep growing at this rate for a long while. What about dilution? So even though this chart looks scary, I invite you to pause the video and look at the scale. It's actually not that scary because we're starting at 0.28 here. So there has been some growth because of the CEO change and the board changes recently, and because of acquisition. But if you were actually to scale it on a base of 0 here, you would see that I would argue stock-based compensation is acceptable for me, although I have a higher level of tolerance for stock-based compensation than most. It's fine for me. Insider ownership is at 39%. The company is not founder-led anymore, so that's bad. Typically, like founder-led companies better. But there's a new CEO, and the new CEO has a lot of experience in a different industry. He was a very successful CEO. I believe it was in energy, and so we'll see how that works. But the new CEO seems to be very experienced, and he may be able to talk to Wall Street and make some changes. It's worth noting that, like I said earlier, the market reacted well when the new CEO was announced. So the market must like something about the CEO. Revenue per employee, kind of my favorite metric. It's $127,000 per employee, the revenue per employee, which would be low if this company was operating in the US. But given that this company is operating in Brazil, I'm considering this to be fairly high because Brazilian wages and the GDP per capita is much lower than the US. So it's actually high for the context of this company, even though in absolute terms that's low compared to a US business or a US company. And so, in conclusion, will StoneCo beat the denominator? Will we exceed 15% a year with StoneCo? Of course, not investment advice. Nothing is investment advice, but I already own StoneCo. I bought it actually at the turn of 2022, so late 2021, 2022. So I'm down on the stock, but I'm not selling the stock. And I am actually adding more to StoneCo recently. I'm not planning on selling anytime soon. Because I think the valuation is ridiculously low, absolutely ridiculously low. I mean, you're trading at 1.5 times next year's gross profit. That's too low for me. I believe this stock will re-rate more in line with the potential, especially for a stock that is growing at 55%. So I want to keep this stock long term. And I'm also fairly optimistic about Brazil and Brazil's future. When I researched my former video on Brazil, I was fairly positive about a few things, and I think they have a young population. I think this is an interesting market to invest in, and so and it's a good diversification because of most of my stocks are in the US, so I like to have a little diversification. So I'm planning on adding more. I think StoneCo is too cheap, much too cheap, and how will StoneCo perform from now? Hard to tell, but to me the downside risk. They seem very, very limited right now. I think the company is quietly recovering from its credit losses. They're writing them off. Yes, they've made bad loans to some business owners, small business owners in 2020, 2021. But as soon as they've noticed that they've made bad loans, they've stopped making the loans, and they're trying to kind of absorb these losses, but the losses that they've had are in nowhere worth a minus 90% of the stock. I think this is a stock that has been overly punished for a mistake. The stock is cash flow positive. There's a new management. There's high insider ownership. Hyper growth at 55%. The product is needed. The market is interesting. This is a stock where I believe there is a lot to like, and I'm happy to add more to this position. Once again, not investment advice. This was just entertainment. I hope you enjoyed the video. Thank you for watching. Please like, please subscribe. I really appreciate it. It really helps me out. And you can also follow me on Twitter. Thank you and have a great day.